Hello and welcome back. In this section, we're going to be talking about pensions. A pension is an agreement in which the employer, he tells the employees, give me all that you have, work for me 100 hours a week all your life, and I'm going to be taking care of you even after you retire. So this carrot which employers show to the employees, this one is called pensions. Now a pension could be a defined contribution plan or a defined benefit plan. First, let's talk about a defined contribution plan. Now in this type of pension, the contribution paid by the employer towards pensions in each period is defined. So this pension which the employer contributes could be a percentage of the employee's salary, it could be a fixed dollar amount. Now all that contributions the employer is making goes into the employee's individual account plans. And the investment risk, what happens to those dollars during the work life of the employee, is the employee's headache. From the employer's point of view, the accounting is pretty simple. The cash is going off their books and it's a pension expense on the income statement. A very good example of a defined contribution plan is a 401k plan, and we'll talk about this also in regulation. Now the more difficult kind of a plan in terms of accounting and a bigger focus on the CPA exams is a defined benefit plan. Now in this plan, the benefits to be received by the employee after retirement is defined. So let's say the employer tells the employee that every year after you retire, I'm going to be paying you a certain percentage, let's say 2%, into number of years you've worked for me, you've slogged for me, into your salary at retirement, and you would continue to receive it till you die. So guys, let's look at an employee timeline here. Let's say at this point the employee is hired. He's hired when he's, let's say, 30 years old, and he retires when he's 65. And after he retires, every year he's going to be getting pensions till he dies. Let's say he dies at 80. So the employer has promised the employee, after they retire, every year I'll give you pensions which would be a certain percentage, let's say 2% into number of years you've worked. So if you worked for 35 years, 70% of this salary till you die. So guys, a lot of complications here, right? Question number one, how do we know what's going to be the employee's salary at retirement? We know his current salary. If he's working here, we know his salary here. But how do we know his salary at retirement? And the second more tricky question is, how do we know when the employee is going to die? So what employers do is they call in a palm reader. Now this palm reader, he goes across the company. He looks at the palm of each employee and he comes back and tells the employee, okay, this employee is going to have this X dollars of salary at retirement and he's going to live for so many years. These highly paid palm readers are called actuaries. So guys, as you can understand, in a defined benefit plan, the employee, they get defined benefits, and it's the employer's worry whether the pension contributions every year, are they enough to fund those projected benefit obligations. So this is called a PBO, a projected benefit obligation, because the pension obligations are based on future salaries, projected salaries. And the company makes investment in plan assets every year as the employee is working, so that they have enough dollars, enough money to pay the employees every year after they retire and till they die. On page 40, we're looking at pension plans. And as I told you, there are going to be two types of pension plans. The first one, highlight defined contribution and put a box around 401k. because that's a very good example of a defined contribution plans, and we're going to talk about 401ks also in regulation. So in a defined contribution plan, the employer sets aside specific periodic amounts of contribution to the plan during the time of employee service. So the retired employee would receive whatever sum these contributions and earnings produce. But we're going to spend much more time in studying defined benefit plan, and put a star there. So in a defined benefit plan, the employer defines the benefits to be paid to the employees at retirement. So it's the employer's responsibility to set aside sufficient fund to ensure that this commitment, this guarantee is met. Due to the complexity of calculation, defined benefit plans calls for the use of an actuary who makes assumptions based on factors like employee salary or compensation at or near retirement, number of years of employee service, life expectancy, interest rates. Now moving to page 41, we can see that the employee after retirement would get his pensions based on his salary at or near retirement. So we're not going to use the current salary levels to determine pensions. We're going to use future salary levels. Now current salary levels, that calculates to accumulated benefit obligation, and put a box around current salary. Make a note there, don't use ABO for calculations. So we'll talk about ABO just being disclosed in the financials, not used for calculations, because for calculations we're going to use projected benefit obligations, and put a star there. Put a box around future salary, and this is benefits years of service method. Now below the tick there, also actuarial calculations are based on PBO, the projected benefit obligation. Now just a little note here regarding different IFRS terminology. So instead of calling it projected benefit obligation, IFRS calls it defined benefit obligation. The benefit years of service method that we have under GAAP is called projected unit credit method under IFRS. Now understanding the concept of pensions, we know that employees, they're going to be paid pensions after they've retired, after they've stopped coming to work. So guys, should we expense this amount that's being paid out to the employees at this point after they've retired when we're paying them cash? No. We are following an accrual basis of accounting. So we would expense the amounts that we are paying them post-retirement during their service life, when they're actually working for us, when they're putting in all the hours. So guys, for all the years that the employee is working, the employer builds up a pension liability and he has a pension expense on the income statement. Now the employer also makes certain investments in pension plan assets so that he has enough dollars when the employees retire. So what I'm trying to say is the employer would have pension liabilities because he's got a projected benefit obligation. The employer would make investments in plan assets and have pension assets, and every period as the employees are working, he's going to have a pension expense on the income statement. Now the first question is how to calculate the pension expense which goes onto the income statement every year. So let's try to understand this by putting a little numbers on this lifeline. Let us say the commitment to pay pensions to the employees is 2% into the number of years worked. So this employee, he's worked for 35 years, and let's say his projected salary at retirement is $50,000. So he's going to be getting 70% of $50,000 each year as pensions after he retires. So that's $35,000 each year. And the date of actuarial death is 80. That means the palm reader, he came in and he said that this employee, he is going to die when he's 80. So that's going to be $35,000 of pensions each year after the employee retires till he is 80 until he dies. Now, the present value of all this $35,000 payable after retirement at the point of retirement, let's say, calculates to $270,000. So this is 65 years and the present value is $270,000 and the date of actuarial death, let's say 80 years. Now, the employer needs to set aside some amount every year so that builds up to $270,000 by the time the employee retires. And from this, they're going to be paying out $35,000 each year till the employee dies. So now the amount that the employer is required to set aside each year from the point the employee was hired till he retires is called the service cost, and that naturally increases the pension expense. So first thing that we're looking at is service cost. Now let's say the actuary calculated that the service cost for each year that the employee is working, is going to be working for 35 long years. So each year it's $1,000. So it's $1,000 each year that the employee is working. So basically this is the increase in the liability, the projected benefit obligation on account of employee service each period. Now looking at this, we said service cost each period $1,000. The employee, he is working for 35 years. That calculates to $35,000. But I said we need to have $270,000 when the employee retires. That is why we have a component called interest cost. So because of the time value of money, this $1,000 each period would grow, and they would grow to $270,000 by the time the employee retires. And naturally, from this amount, he's going to be getting pensions $35,000 each year till the date of actuarial death. So guys, the interest cost is basically beginning PBO, the beginning projected benefit obligation of the employer into discount rate. Now a lot of estimates are coming from the palm reader, the actuary. He told us the salary of the employee at retirement. He told us when the employee is going to die. He is going to tell us this discount rate. And we are multiplying it by the beginning projected benefit obligation. Now, since I've been giving you PBO, let me further expand on this PBO calculations also. So I'm doing the pension expense there. Let me do PBO on this side of the board. I'm going to use my entire board in trying to teach you pensions. So we're going to have a beginning PBO. So a beginning liability for the employer, and to that he's going to add the service cost for the period. So the service cost for the period is pension expense, also increases liability, and naturally the interest cost, that's a pension expense, increases the liability. Guys, the liability at this point when the employee retires is going to be $270,000. We got to build it up. So let me put the journal entry for this. So service cost and interest cost. So if I want to put the journal entry for this, I would say it's going to be pension expense debit. Pension expense goes to the income statement, and the credit is to pension liability which goes to the balance sheet. For service cost, we said it's going to be $1,000 each period. Interest cost, what we're going to do is we'll take the beginning PBO that we had there and multiply it by the discount rate which the actuary has given. Now till now, it's more or less simple and easy. Now let's a little spice. Let's say the company did not have a pension plan when the employee was hired. He worked very hard, he slogged, he put in the hours and he made the company grow. Now after 5 years of he joining the company, that's when the company decided to start a pension plan. Now naturally the company would recognize the employee's hard work for the first 5 years and they said they're going to give the employee pension benefits retrospectively from the date he joined. So guys, when he joined, there was no pension plan. Let's say the pension plan came in 5 years later. So he joined at 30. The pension plan came in at 1, 2, 3, 4, 5 years later at this point. And he's going to be getting pension benefits right from the date he retired. So on his retirement, we're not going to take just the 30 years that the pension plan has been into existence. We're going to take the entire 35 years. Now think about it. The employer has a liability right away. He's got a liability to put aside enough money so that he can give retrospective benefits to the employee even when there was no pension plan into existence. So naturally, when we do a journal entry for this, the credit is to pension liability, and let's do that there. When we have a prior service cost, the credit is to pension liability. When we had service cost and interest cost, we said the debit is pension expense which goes to the income statement and there is a pension liability being created on the balance sheet. Now here, when we are having a prior service cost, a pension liability, do you again want to debit pension expense? So that would mean because the company, the employer, they started a pension plan on that day, immediately they had to expense the liability for the previous 5 years. That would not be fair. So what we do is we park this. And guys, the moment I use the word park, I saw a glitter in some of your eyes. And I know you recall my favorite parking lot accumulated OCI. So what we do here is instead of debiting pension expense and taking into the income statement, we park it on the balance sheet, we park it on accumulated OCI. So the prior service cost that gets created because of a new pension plan or a pension plan amendment is parked on the balance sheet. So this is balance sheet and this one is balance sheet. So nothing goes to the income statement via the creation of the new pension plan, prior service cost. Now what we do is we amortize a portion of the prior service cost each period. So let us say the pension plan was started here. Now we're going to amortize a small piece of the prior service cost each period over the remaining service life of the employee. So we're going to amortize it from 35 to 65 years. So on the pension expense, we're going to have a prior, oh, good catch, prior service cost amortization. When we created the prior service cost, it was accumulated OCI debit and pension liability credit. Now when we are amortizing it, we need to take it out of accumulated OCI. So when we created the prior service cost, this went into accumulated OCI. The mnemonic for this was PACE, and we are looking at the P of the PACE, that's pension adjustments. So when the prior service cost was created, there was a liability and accumulated OCI parking. Now, every period we're going to take out a portion from accumulated OCI and expense on the income statement over the remaining service life. So the journal entry for that would be pension expense debit, and now we're going to be taking out amounts from accumulated OCI on the balance sheet. So the debit is income statement, the credit is from the balance sheet. So initially you parked it, then you take it out each period, amortize the prior service cost. So on the projected benefit obligation, we had the creation of the prior service cost. When suddenly on a day the employer says we need to have our pension plan, or we need to improve or increase the benefits that our pension plan is providing, prior service cost created. Now every year there will be amortization of this prior service cost, which gets added to the expense amount on the income statement. Totally understand that the concept of pensions, they tend to get a little different, a little complicated. Think about it, that holds true even in real life. Now, you've been working hard all these years, and then suddenly one day you're asked to sit back at home, water your gardens with your pension checks being sent out to you. So instead of getting jittery about this, it's time to relax. And guys, I'm going to give you a lovely mnemonic, a relaxing mnemonic for you to remember all the components of pension expense. So we're looking at the pension expense calculation. And I've started with service cost, interest cost, prior service cost, amortization. And as we come back, I'm going to give you the other components of pension expense, which are going to be actual returns, deferral of excess gains and losses, amortization of excess deferred gains and losses, transition obligations, and then net pension expense. So as you look at all these components, we build up our mnemonic. So as part of pensions, I want you to SIP, rejoice, and date. So guys, once again, a very simple, easy way for you to remember pensions. So as part of pensions, after you retire, it's time for you to SIP, rejoice, and date. Now let's get to page 42 of your book, where we learn more about SIPPing, rejoicing, and dating, because that's how you calculate your net pension expense. So look at the timeline on the top of this page. You have year 1, the employee was hired, but there was no pension plan then. The pension plan was initiated by the employer only in year 6. So that period, year 1 to year 6, is highlight prior service cost. Because the employee, he's going to be receiving pension benefits retrospective from the date he was hired from year 1. Now looking from year 6 through year 28, so year 6 pension plan initiated, year 28 the employee retires, that is highlight service cost each period. So the actuary would give an estimate on how much the employer should be putting in every year. So that is service cost. Now after retirement, there is benefits being paid out to the employee. So highlight payout to employee benefit period. And the actuary assumes that these benefits would be paid out till the date of actuarial death. We're going to be using our mnemonic SIP, rejoice, and date to calculate the net pension expense. So now let's talk about the first 3 components, the S, I, and P of SIP. So on the first bubble there, write S, put a plus sign there and highlight service cost, because this is the increase in the projected benefit obligation on account of employee service in the period. Now this represents the amount that needs to be set aside by the employer each year over the service life of the employee to fund promised benefits after retirement. So though the employee is going to be getting benefits after he retires, he is getting those benefits because he's put in the hours today, and that is service cost. The next component, put I on the bubble, put a plus sign there and highlight interest cost. Now the PBO, the projected benefit obligation, was computed by the actuary based on present value, and therefore this PBO, it needs to increase over time. So the interest cost is the increase in PBO resulting from the passage of time, and it's calculated as the beginning projected benefit obligation multiplied by the discount rate or the settlement rate. The third component, highlight prior service cost amortization. Put a box around amortization, write P on the bubble there, and write general rule, or GR is plus. So as a general rule, the prior service cost amortization leads to an increase in pension expense, unless the prior service cost was created due to a plan amendment where reduced benefits were to be provided to employees. Now generally, prior service cost is created when a pension plan is initiated or more benefits are to be provided to employees. So that's why we would say generally the amortization of these prior service cost increases the pension expense. Now the amortization is by using underline straight line method. So you look at the beginning prior service cost and amortize it over the average remaining service life of the employees. Now right there, unamortized is an accumulated OCI. So the unamortized portion of the prior service cost, that lies on the balance sheet in accumulated OCI, and every period we amortize a piece of that on the income statement. Now besides the straight line method, you could also use underline expected years of service method. Now in this method, you calculate a ratio where you look at the number of service years put in by the employees in this year, the current year, divided by the total expected number of service years for all the employees. Now this ratio is multiplied by the prior service cost to calculate the amortization for the period. Now it's said that age does not protect you from love, but love to some extent protects you from age. And hence my mnemonic for you to remember pensions: sip, rejoice and date. Now looking at the employer's perspective, think about him. He is having a projected benefit obligation building up each year as the employees are working for him. He's going to make sure that when the employees retire, he's got enough dollars to pay them pensions. So as and when the employees are working, he would want to make certain investments such that as the pension liabilities are growing, his investments also grow. We've already looked at projected benefit obligation for the employer, and now let's look at the pension plan assets, the investments that the employer is making. So these were the pension liabilities, the projected benefit obligation, and now we are looking at pension plan assets. Now we'll start with the beginning fair value of plan assets, all the investments that the employer has already made until last year. Now, to this number, we're going to be adding the contributions that the employer has made this year towards this pension plan assets. Now, naturally, these assets, these investments would yield returns to the employer, and as he gets returns, the fair value of plan assets increase. So this is plus returns. As you can understand, these returns from pension plan assets helps him offset the pension expense. These returns help the employer reduce his pension expense, which goes on to the income statement. So let's look at a pension expense calculation, and we've already set out the components of pension expense. So we started with service cost each period, then we had plus interest cost, growing the liability, plus any prior service cost amortization. Now, as I said, returns would help the employer reduce the pension expense. So this is a negative number. We're looking at returns on plan assets, and here we're looking at actual returns. Now, thinking about it, if the markets are doing good, the employer's pension plan assets, they would give very good returns. So if this number is very high, this would help the employer reduce pension expense. So in other words, if the markets are doing good, the pension expense on the income statement would be low. Now think the other way around. How about when the markets are doing bad? Now in that case, this returns number, this would be very low, and the pension expense, that would be very high. So that would be a increased expense on the income statement. So this would mean that the pension expense number out here would actually depend on market returns. This does not sound good. This does not look proper matching. And that is why what we do is we're looking at actual returns here, but we defer excess gains or losses. Basically, what we do is we have an expected return. So markets, some years they're going to do good, some years they're going to do bad. So instead of having good and bad returns, we have an expected return. And anything, let's say, if the markets are doing too good, then the excess returns over expectation is deferred. When the markets are doing bad, then the excess losses below expected is deferred. So we're going to defer the excess gains and the losses. So that's the D of your date. Now, when you defer excess gains, that increases pension expense. When you defer excess losses, that reduces pension expense. I know this one might be getting a little tricky, and I'll put in numbers to make sure you understand this concept very thoroughly. Now, let's try to build this up. I said the service cost each period is $1,000, and the pension plan came in 5 years after the employee joined. So let us say the actuary said at this point the pension plan liability was, let's say, $6,000. And then let's look at the 7th year. So $6,000, that would have interest for 1 year, let's say 10%, 6,600, plus service cost for the 6th year, that would be 7,600. So let us say the beginning PBO as of the 7th year, I'm just putting in numbers here, $7,600. The service cost for the 7th year, that would be $1,000. Interest cost would be the beginning PBO into 10%. So 7,600 into 10%, that gives us 760. Now, putting in numbers for the plan assets, let's say the pension plan naturally started last year, and last year the employer invested $2,000, or rather the ending fair value of plan assets as of the last year was $2,000. So that's the beginning number. Now, the employer expected a 10% return on this plan assets. But this year, the stock markets, the debt markets, they didn't do so good. And he just got $75 of returns. So guys, 10% of $2,000, the expected returns, $200. He just got $75. So what happens? Let's put it. So we're having a service cost, and we said it's $1,000. The interest cost for this year, we've put in a number, 760. The prior service cost amortization, So let's say we are amortizing the $6,000 over 30 years. So 6,000 divided by 30 gives us $200. Now coming to this important returns actual. Now the beginning fair value of plan assets, we put in a number $2,000. The expected return $200, 10% of that. But the actual returns was only $75. So the negative number is 75. So beginning fair value of plan assets $2,000. The employer expected a 10% return, $200. He just got 75. So that's a market doing bad, that's a loss, and this is a loss that the employer he is going to defer. And I said deferred loss is negative. Think about it. So he is having a deferred loss of $125. So guys, minus 75 minus 125, that's minus 200. What's minus 200? That was the expected returns. So this plus this is expected returns. Now let us say the plan assets, $2,000 beginning fair value, they had an expected return of 10% and the actual return was also 10%. So the actual return was equal to expected return, $200. Would you have any deferral of excess gains or losses? No, actual is same as expected. So this plus this, again negative $200. Let me give you a third case now. Let us say that the actual returns on plan assets, the expected was 200, the actual was 250. So here the actual return becomes a negative 250. What you do is you defer $50 and deferral of excess gain, you add it here. Minus 250 plus 50, the sum is minus 200 expected returns. So guys, I'm sure you're getting what I'm trying to give out here. What I'm saying is, irrespective of markets doing good or markets doing bad or markets doing as expected, this plus this would always give us expected returns. So this is returns actual, and we would defer any excess gains and losses from the market, such that the sum of these two give us expected returns. And the pension expense number on the income statement does not fluctuate with the market performance. It remains more or less a constant number, because we know markets do good in one year, they do bad in the other year. Overall, it balances off. There is an expected return which holds true. Now, putting in journal entries for this. So when we have returns actual, it helps in reducing the pension expense. So now the pension expense is a credit number. So just a reversal of this journal entry. It helps us reduce the pension liability and reduce pension expense. Now, when we're looking at deferral of gains and losses, in that case, let's first look at the journal entry for deferral of losses. So in the first example which I gave you, I said the returns actual, they're just $75. Expected was 200. You're going to defer this loss of 125. What is happening here is there's a loss which is being deferred, which reduces the pension expense. So the pension expense is credit, and the loss which we defer it in accumulated OCI. Guys, for pensions, whenever I talk about deferral, I'm putting it into accumulated OCI. When I amortize the deferral, I'm taking it out of here. If you remember, when we talked about prior service cost, initially when we had a prior service cost, when the pension plan started off, there was a liability and the plug was to accumulated OCI. When we amortize the prior service cost, we take it out of accumulated OCI. Similarly here, whenever you're deferring it, you're putting it in accumulated OCI. So your debit here is accumulated OCI. Now that's a deferral of losses. So this would help you reduce pension expense. Now, if the returns were more than expected, $250, then you had to defer the gain, and we had to make sure that the pension expense increased, because these returns, excess returns, really decrease the pension expense, increase it back up. So now your journal entry for deferral of gains, the excess gains over expected, is pension expense. So defer losses, defer gains. So that's pension expense debit, and this gain goes into accumulated OCI. So guys, as you can understand, instead of taking these losses to the income statement, we park it on the balance sheet. Instead of taking this excess gains on the income statement, we park it on the balance sheet in accumulated OCI, the parking lot. So let's get to the book, look at rejoice and the D of date, and I'll come back and I'll complete the date. On page 43, highlight return on plan assets, and we're talking about actual returns. So fill in R on the bubble there and put a minus sign. Now this represents the earnings of investments from the pension plan. Now these earnings, they naturally reduce the amount the employer has to fund. It reduces the net pension expense. Now these returns, they might not be the same as the expected returns, and that's why we have highlight deferred gain or loss from plan assets. So we defer the difference between the actual returns and the expected returns. Fill in D on the bubble and put a plus or minus. So if it's a deferred gain, it would result in an increase in the net pension expense for the period. If it's a deferred loss, that reduces the net pension expense for the period. Now to understand actual returns and expected returns, let's look at the calculations and put a box around that. So we have returns actual, they reduce the net pension expense. To that you add deferred gain or you subtract deferred loss, and this gives you return expected. So the net of R and D gives you expected returns on plan assets. Now we have been looking at deferrals which get accumulated in accumulated OCI. So first we had talked about deferrals of prior service cost. So when we had no pension plan or there was a pension plan amendment, we built up a liability on the balance sheet and we deferred it on accumulated OCI so that it could be amortized over the remaining service life. And then we had these deferred gains or losses where the actual returns were different from expected. Now in a moment we'll also talk about actuarial gains or losses. So here we're looking at those palm readers who gave us some estimates, and later those estimates changed and we had gains or losses due to the change in those actuarial estimates. Now here we've looked at deferrals of gains and losses. So we're going to defer the actuarial gains and losses along with these gains or losses which result from expected returns different from actual returns. Now let us say we have a lot of pile up of these deferred gains or a lot of pile up of the deferred losses. Let's talk about it. Let's say this is our expected return. In year one, we had actual return more than expected. What do? Defer the excess return. Second year, again, the actual is more than expected. Again, we defer it. Third year, the actual return was more than expected. We again defer the gain. So we are having gain, gain and gain. So we are having a lot of deferred gain being piled up. In a way, you could say that we had actually under expected. On the other hand, let's talk about deferred losses. So let's look at this being our expected return and the actual return less than expected. Defer the loss. Second year, expected, actual, less than expected. Defer the loss. Third year again, actual less than expected, definite loss. Lot of loss getting piled up. Now in this case, you could say that we had sort of over expected. So now we are looking at a lot of pile up of these deferred gains or deferred losses. So what we do is we're going to set up a limit. We're going to say if the deferred gains or the deferred losses exceed those limits, we're going to amortize the deferred gains or the deferred losses. Now these limits that we set are called corridor limits, and the corridor limit that we have is 10% of the higher of beginning PBO or the beginning fair value of plan assets. So in the numbers that I've been trying to bring up here, let's look at this. So for this year, the beginning PBO was $7,600. The beginning fair value of plan assets, that was $2,000. What's higher? Naturally, $7,600 is higher. What's 10% of this? $760. So $760 is the corridor limit with these numbers. Now, if the deferred gains or the deferred loss are more than $760, then we would amortize them over the remaining service life. So guys, here let's say we have a deferred gain of $50. That's well below $760, no amortization. But if the deferred gains start piling up and they're more than $760, then we're going to amortize them. So the logic here is, if the deferred gain is more than the corridor limit, then we could say we have had conservative estimates. We have sort of under expected. If the deferred loss is more than the corridor limit, then we could say we've had aggressive estimates. We have over expected. So now by amortizing these excess deferred gains and losses, we're going to make sure we make up for those conservative or those aggressive estimates. So this A of date, that's amortization of excess deferred gains or losses, and this is corridor approach. So when we deferred the gains, it increased the pension expense. Now when you amortize the excess deferred gain, that's going to reduce your pension expense. When we deferred the losses, the excess losses, then it reduced pension expense. When we're going to amortize the excess deferred loss, that's going to add to the pension expense. So the sign simply changes. So looking at the signs here, deferral of gain. So when you defer gain, it increases pension expense. It's a plus to pension expense. Because guys, accumulated OCI. So instead of taking out on the income statement, you're taking the gains to accumulated OCI. So the gain, this is credit. Naturally, the debit is pension expense. Pension expense goes up with deferral of gain. Now here, when we deferred losses, losses is a debit number. Instead of taking to the income statement, you're parking it in accumulated OCI. Pension expenses reduces, minus. So that's the plus or minus. So plus for the gain, minus for the deferral of losses. Now when you're amortizing it, it's simply a reversal of these journal entries. So defer losses, accumulated OCI debit, pension expense credit. Now when you amortize deferred losses, amortize deferred losses, here the pension expense get debited and accumulated OCI is credit. So basically here you put the losses in accumulated OCI. When you're amortizing it, you're taking it out of accumulated OCI. Now let's look at this. The journal entry that you had for prior service cost amortization. Now this was again sort of a loss, sort of a liability that you had parked in here, and when you took it out, you increased your pension expense. That's the same journal entry as here. And here you had excess deferred losses. Similar case. But if you have excess deferred gains, so if you amortize deferred gains, then the debit is to accumulated OCI and the credit is to pension expense. So in this case, when you deferred losses, pension expense reduced, minus. Put your black pen for this. So this is a minus. Now when you amortize the deferred losses, pension expense is a plus. When you're looking at deferred gains, when you defer the gains, pension expenses increases, it's a plus. So that's why I said plus minus, deferral of gains and losses. So let me put it, deferral of gains and losses. Now when you amortize excess deferred gain, when you amortize the excess deferred gain, pension expense is a minus. When you amortize the excess deferred loss, pension expense is a plus. So it's the way you're convenient with understanding this. A good way that I would recommend is doing it via the journal entries. So I know when I'm deferring my losses, the debit instead of income statement, so instead of debiting my net income, I debit accumulated OCI, park it there. Naturally, when I take it out from there, I got to credit accumulated OCI. Now when I'm looking at gains, instead of taking the gains onto my income statement, I park it in accumulated OCI, the credit accumulated OCI. Now when I'm amortizing this excess deferred gain, then I take it out of accumulated OCI. How do I take it out? I have credited here, I have to debit. The other side is pension expense. So deferral of gain increases my pension expense. The amortization of deferred gain reduces pension expense. Deferral of losses reduces pension expense. Amortization of deferred losses increases the pension expense. Now, so that was about deferral of gains and losses, amortization of excess deferred gain or losses. And as I told you, when we come back, the next section, we're going to look at actuarial gains or losses. So when you're using the corridor limits, you add the actuarial gains or losses to these numbers to make it a total deferred gains, a total deferred losses. Make sure if they are exceeding the corridor limits, you amortize them. So that's the D and A. Now the T of date, this stands for transition gains or losses amortization. So if I'm looking at T here, I'm looking at transition gain or loss amortization. Now what happened was in 1987 we had new rules, all these rules for pensions, and there was a transition for companies. Now on this transition, companies could have gains or losses, and the companies were allowed to amortize these transition gains or losses. But guys, this one, the T of date, is not too important right now, as most of the companies have fully amortized their transition gains or losses as of date. Now DAT, so this again is amortization. So before moving on, let me put together all the amortizations that we have here. So this was a prior service cost amortization. This is amortization of excess deferred gains or losses. This is transition gain or loss amortization. So we've looked at SIP, SIP, Rejoice, and DAT, and then we're coming to the E. The E is basically the expense number. So E is basically the expense which goes on to your income statement. So E basically is the pension expense number. So guys, looking at this lovely mnemonic again and again, it's SIP, Rejoice, and DAT. And as I teach you this amazing concept of pension expense and this lovely champagne lying right here on my table, I can't help but sip it again. And this is the last time. Sip, rejoice, and guys, it's time to date. Getting back to page 43 of your book, highlight amortization of excess deferred prior gain or loss from plan assets. Put a box around amortization, write A on the bubble, and the sign is minus/plus. So if it's an amortization of excess deferred gain in that case it reduces pension expense. But if it's amortization of excess deferred prior loss from plan assets, that's addition to the net pension expense. Now, we know that the unamortized portion of the deferred gains or loss, that's on the balance sheet, that's an accumulated OCI. So right there, unamortized is an accumulated OCI. Now, we've seen the calculation of these amortization of excess deferred gains or losses. That's by highlight corridor approach. So, you take the beginning deferred amount and you subtract, circle 10% of, put a box around higher of beginning PBO or beginning plan assets. So, if the beginning deferred amount is more than the 10% of the higher of beginning PBO or beginning plan assets, then you amortize it over the average remaining service life. This one is called the corridor approach. Moving to page 44, we are looking at the T of the date. So write T on the bubble, and this stands for the transition adjustments which are amortized. So put a box around amortization, and right there, unamortized is an accumulated OCI. So whatever is unamortized, that lies on the balance sheet, an accumulated OCI, and when you amortize it, you take it to your income statement, and that affects your pension expense. Now, these transition adjustments, as I told you, are not so important currently because they are underlined no longer a component of net pension expense. This transition, it happened ages back in 1987. Now, let's complete the date. So, put a bubble there and write E, and this E is your net pension expense. So, with this, we've talked about SIP, rejoice and date, and this is how we calculate our net pension expense. Now that you have my mnemonic for you to calculate pension expense, and I've also introduced you to the concepts of projected benefit obligations, the pension liability that's been built up, and plan assets, the investments that the employer is making. Let's first try to understand all our reporting objectives out of pensions. So for pensions, we're first looking at the expense number on the income statement. Now think about it. If it's a pension plan for factory workers, the pension expense that goes into COGS. If it's a pension plan for salesmen, marketing guys, that is selling expense. If it's a pension plan for officers, that's general and administrative. So all the pension expense ideally goes into operating income. So that's the income statement impact. Looking at the balance sheet, as we know, as and when employees are working, the pension liability for the employer starts building up. And the employer makes investments in plan assets such that he has enough money to pay those employees when they retire. So there's a liability and an asset building up. Now, it would not make sense to have a liability number and an asset number. It'll just make it messy. So what we do is we net the asset and liability. If the liability, the pension liability is more than the pension asset, in that case it's an underfunded plan. But if the pension assets are more than the pension liabilities, that is an overfunded plan. Now, for a company which has multiple pension plans, what we do is we put all the underfunded plans together as one pension liability number and all the overfunded plans together as a pension asset. But we do not net overfunded and underfunded plans. So guys, once again, for each pension plan, you'll just have one number, either a liability or an asset. A liability means an underfunded plan. Liabilities are more than assets. A net asset would mean an overfunded plan where the assets are more than liabilities. So guys, we're looking at the expense number which goes into the income statement. We're looking at the net pension liability or pension asset. And the third thing that we're looking at is accumulated OCI. Now, as you recall, we are deferring gains and losses into accumulated OCI and then amortizing it. Now, the unamortized portion that remains in accumulated OCI on the balance sheet. So, with the reporting objectives now pretty clear, let's go across this board and filling the missing pieces for our pension accounting. So, pension expense, we've seen SIP, rejoice and date. Now, looking at this more closely, when we're looking at service cost, interest cost and returns, now these affect our pension expense naturally and liability. So, service cost and interest cost increase the pension expense. Returns reduce pension expense. And the opposite side is the pension liability. So, if it's an underfunded plan, this would be a pension liability. If it's an overfunded plan, this would be a pension asset. So, you could say it's S, service cost, plus interest cost minus returns. Now, the next part, the D of date, this is deferral. So, this affects pension expense and the deferral happens in accumulated OCI. The third part, I'm looking at P, I'm looking at A and I'm looking at T. Now, all this PAT, PAT, that's amortization. Prior service cost, amortization. Amortization of excess deferred gains or losses. Transition gains or losses, amortization. So, all these three are amortization out of accumulated OCI. So, prior service cost, that's generally an amortization of a loss, a liability lying in there. So, that increases pension expense, take it out of accumulated OCI. Now, amortization of excess deferred gains or losses, if it's losses, that's the same journal entry. If it's gains, you debit accumulated OCI and that reduces your pension expense. So guys, what I've done is accounting for pension expense split into three parts. Part number one, I'm looking at S plus I minus R. Then I'm looking at D. Third part, amortization, I'm looking at PAT, P-A-T. That helps me calculate, account for pension expense going into my income statement. And what I'll do is, the accounting, the entire accounting that we have for pensions, I'll break it up into steps. And calculating the pension expense, I would say this one is step number one. This is the first thing that you do when you retire. SIP, rejoice and date. Now, let's look at step number two. Now, we had deferral of gains and losses here. When let's say this was expected, the actual returns more than expected, that's deferral of gain. The actual returns less than expected, deferral of loss. So, this was about returns on our plan assets. How about when the actuary comes in, goes around reading palms and he says the estimates that I have this year are different from those that I had last year. A change in actuarial estimates. So, that's step number two. Now, it could be an actuarial loss or an actuarial gain. Now, think about it. Let's say the actuary comes into a company and he says, last year I said that your employees, they're going to die when they're 80 years old. But then he goes around the company and he's so impressed. We got a lovely gymnasium and all our employees, they stay fit. They work out for at least an hour each day. We got a lovely in-house cafeteria. where we don't serve heavy food, oily food. That's all homemade, less spicy, less oily, less fatty food. So now he says, because of the healthy ways of living that's there in your company, employees will live more. Instead of dying at 80, they would die at 85. That's good news. Wait a minute. That's an actuarial loss. Now, the company would have to pay them more pensions. So instead of paying them pensions for, let's say, 15 years after they retire, the company would have to pay them pensions for 20 years after they retire. An actuarial loss due to a change in actuarial estimate. He said employees are going to live more now. Now, what do you do with this loss? Naturally, you don't expense it, you defer it. Where do you defer it? All the deferrals in accumulated OCI. But this actuarial loss, along with the deferral, the other side of the journal entry is to pension liability. You build up the pension liability. Don't expense it right now. Build up the pension liability, and if the deferred gains or losses go beyond the corridor approach, that's when you amortize it. So guys, let me put the journal entry and I'll explain to you once again. So if there is an actuarial loss, the actuarial loss gets parked into accumulated OCI. Now, when you had a loss here, when you deferred the losses here, you credited pension expense. But if it's a change in actuarial estimate, you're going to credit pension liability. So because the actuary said the employees are going to live more, it's a liability for the company. The pension liability increases and you park that on accumulated OCI. And then every year what you do is you put these losses and these losses together. And if these two together exceed the corridor limit is the 10% of the higher of beginning PBO or beginning fair value of plan assets. So if this plus this deferral for all the years put together exceeds the corridor limit, that's when you amortize here. Similar rules for gains. Now let's say we are really growing. All our employees, they are working for 100, 120 hours a week. They got no time for nothing. They just come to work, sit on the chairs all day and work. And the actuary comes in and he says, my God, this is so unhealthy. These guys, they're so used to working. First thing, I don't know how long they're going to survive after they retire. And the second thing, they're so addicted to work that the moment they retire, they won't be able to live for more than 3 months or 4 months or maybe a year at max. Now this could be an actuarial gain because now the actuary is saying that the employees, instead of living till 80 years, they're going to die at, let's say, 70 years or 66 years. The company has got to pay them less pensions out. Now this is again a change in actuarial estimate. Last year he said 80, now he's saying 70. And this is a gain from change in actuarial estimates. Now this gain again gets parked into accumulated OCI and is amortized if it exceeds corridor limits. So let's first look at the deferral journal entry. So here when we deferred the gain, it was parked into accumulated OCI. So accumulated OCI is still the credit, but we don't expense it yet. So this one goes into pension liability. It reduces the pension liability. It's an actuarial gain. Naturally, it's less pension liability now. And when this gain plus this gain, these two put together, they exceed the corridor limit. That's when we amortize the excess deferred gain. So when you create the deferral, the credit is accumulated OCI. When you amortize the deferral, you debit accumulated OCI. So this one is putting into accumulated OCI, and amortizing is taking out of accumulated OCI. So that's the logic, the way of thinking that you need to understand when you're looking at accumulated OCI for pension accounting. So that is step number 2. When we're looking at change in actuarial estimates, could be an actuarial loss or an actuarial gain, and you defer actuarial loss, defer actuarial gain, this plus this loss, you amortize if it's exceeding the corridor limits. this plus this gain, you amortize if it's exceeding the corridor limits again. So that was step number 2. So step number 1, we did the pension expense. Step number 2, we've looked at change in actuarial estimates. Step number 3, we are looking at how much has the employer set aside this year. Has he at least set aside how much the pension expense was? So if you calculate the numbers that I have put in here, so it says $1,000 plus 760, 1760 plus 200, 1960. Minus 200, you remember these two together, that's expected return minus 200, that again gives you 1760. So the expense number is 1760. So that's the pension expense. Now the question is, how much has the employer contributed this year? Let's say this year the employer put in $1,500 into the pension plan assets. So step number 3, we are looking at contributions to pension plan. Now naturally the contributions to pension plans would reduce the liability. Guys, though we have two numbers, a liability and an asset, finally on the balance sheet they get netted. So for every journal entry that we have, this could be a pension liability or a pension asset. So if it's an underfunded plan, this would be a pension liability. All these numbers, wherever I have liability, would remain liability. But the moment it's an overfunded plan, all these numbers would become pension assets. So it's just one number on your balance sheet, on your books of accounts. So contribution to pension plan. So I could say, in that case, the pension liability is reducing, or if it's an overfunded plan, I could say pension asset is increasing. So either the liability reduces or the asset increases and cash is going out. Now we're done with 3 steps. Calculated the pension expense, looked at any change in actuarial estimates. Did the palm reader say something different this year than what he said last year? And then we're looking at how much did we keep aside, how much did we contribute to our pension plans this year. Now step 3 done, let's look at step 4. So step 4, we already started doing this. We had the beginning projected benefit obligations, and now in step 4 we are looking at the ending PBO. So here we started with beginning PBO, we added the service cost. Where did we get the service cost from? We got this from the pension expense. This is the S of the SIP. The interest cost, this is the I of the SIP. Then we had prior service cost. So this was the creation, the deferral of the prior service cost when we suddenly started a pension plan, or we amended the terms of the pension plan. This number got deferred into accumulated OCI and then was amortized here. Now, when we looked at change in actuarial estimates, we again had pension liabilities here. So let's say if we have an actuarial loss, that would increase the pension liability. If we have an actuarial gain, that would reduce the pension liability. So I could say minus or plus actuarial gain or loss. So if it's an actuarial gain, pension liability is minus, debit. If it's an actuarial loss, pension liability is a plus. Now, if the company has paid out some benefits, so let's say a lot of employees still working for the company, some employees have retired. The company, what they do is they liquidate the plan assets so that they can pay off the pensions to the retired employees. I mean, that was the entire purpose of making the investments. So when they are making out those payments, benefit payouts, that would reduce their liability, and at the same time that would also reduce their plan assets. So the payouts, the benefits being paid out to retired employees would reduce PBO as well as plan assets. So you would have minus benefits here and minus benefits here. Now this gets you to ending PBO, ending projected benefit obligation. So this was step 4. I got service cost and interest cost. I got these two from step 1. I got actuarial gains or losses. I got this number from step 2. And then I looked at the benefits being paid out, calculated the ending projected benefit obligation. Now we also need to know the ending fair value of plan assets. So we've looked at the beginning fair value of plan assets, and from step 3 we got the contributions this year. And let's say the contributions this year, they were $1,500. And then we had returns. This number was from step 1. SIP, rejoice and date. Actual returns, that was the R of rejoice. Now actual returns we said was $250. Expected was 200. Actual 200, how did we get that? 10% of 2000. So we expected 10% returns. But the actual return was 250, more than expected. So naturally, we had deferred the excess gain. But for the plan assets, it's increased by 250. So we have the entire 250 here. Let's say this year, no benefits were paid out, and we're going to calculate the ending fair value of plan assets. So this is 2000 plus 1500, 3000, 500 plus 250, 3750. This one is 7600 plus 1000, that's 8600, 9360. Assuming that benefits paid out during the year is 0, this is 0. So step 4, ending PBO 9360. Plan assets, let me call it step 5. Guys, I understand pensions, they can end up getting a little complicated, a little different. So I've broken it down into steps so that you can easily connect the dots and make an entire picture out of it. So we've done step 4 where we did ending PBO. Step 5 where we did plan assets. Now I've linked both these steps to what you've done on the other side of the board. So I said from step 1 we have taken S, service cost, I, interest cost, and R, returns, SIR. If you remember SIP, rejoice and date, I said SIR. They affect the net pension asset or liability. The PAT, that was amortization, accumulated OCI. The D of date, that was deferral, again accumulated OCI. So only S, I and R affects the net pension asset or liability. Actuarial gains and losses from step 2. Contributions from step 3. Benefits paid out, reduce assets, reduce liabilities. Calculates your ending PBO, your ending fair value of plan assets. Now, do we have two numbers on a balance sheet or just one number? We're going to have just one number. So the step 6, the last step, is going to net these two. So step 6 is net. So if PBO is greater than plan assets, then on the balance sheet we're going to have a liability, and we would say this is an underfunded plan. Now if the PBO is less than the assets, that means the plan assets, the investments, are more than the pension liabilities. In that case, on the balance sheet, we're going to have an asset, and we would say this is an overfunded plan. So guys, I'm pretty sure you're getting the tricks here. Number 1, let's get back. So step number 1, we are looking at the pension expense number which goes into the income statement. Then after that, we also looked at change in actuarial estimates, contribution to the pension plan. Step 4 and 5 and 6 was targeted at calculating the net number, the net pension liability or the net pension asset. Net pension liability, underfunded plan. Net pension asset, it's an overfunded plan. So on your income statement, you're going to have pension expense. On your balance sheet, you could have a net pension liability or a net pension asset. And all your unamortized items, your unamortized prior service cost, unamortized gains or losses, all that they would remain in accumulated OCI. So income statement expense, balance sheet asset or liability, and unamortized in accumulated OCI. Now I have broken down this complex pension accounting into just 6 simple steps. So on page 45 and 46, we're going to be looking at step 1 through step 6 of pension accounting. And then on page 47 and 48, I'm going to tell you how to report these pension items on your financial statements. So let's start with page 45, where we're looking at pension accounting, and highlight step number 1, that's calculating, highlight pension expense. And we know this means SIP, rejoice and date. So now recording the pension expense on your books, we'll first take S, I and R, which affect your pension liability. So highlight increases pension liability or decreases pension asset, and that's S plus I minus R. So service cost plus interest cost minus actual returns. On the journal entry where you have net pension expense, put an upward arrow and write I/S. Now let's look at the other components of net pension expense. Let's look at P, A and T. All these three, they are highlight amortization of the amounts lying in accumulated OCI, P plus A plus T. Now guys, when you're amortizing a loss or a gain, you're taking it out of accumulated OCI. So when you're amortizing a loss, that means a credit to accumulated OCI. When you're amortizing a gain, that's a debit to accumulated OCI. So looking at the journal entries, the first one, that's amortization of loss. So your net pension expense goes up, draw an upward arrow and write I/S. Put a box for accumulated OCI and write amortize loss, that means take it out of accumulated OCI. The next journal entry, again put a box around accumulated OCI and write amortize gain equals take it out of accumulated OCI. The credit is to net pension expense, which put a downward arrow, goes down and write I/S. So you're taking out from accumulated OCI on your balance sheet, putting it onto your income statement. If it's amortization of a loss, naturally that would increase your net pension expense. If it's amortization of a gain, that reduces your net pension expense. Now we've looked at S, I and R. We've looked at P, A and T. What's remaining is the D of date. So highlight difference between actual and expected return is deferred and highlight D. Now deferral means you're putting it in accumulated OCI. When you're deferring a loss, that means you're debiting accumulated OCI. So put a box for the accumulated OCI and write excess loss deferred equals put in accumulated OCI. The credit, that's to net pension expense, which now goes down, draw a downward arrow and write I/S. But if it's deferral of excess gain, that increases your pension expense. So net pension expense, draw an upward arrow and write I/S. Put a box for accumulated OCI and write excess gain deferred equals put in accumulated OCI. So that was all your step 1. Now we have highlight step 2 and highlight change in actuarial assumptions. So it could be an actuarial loss being deferred or an actuarial gain being deferred. If it's an actuarial loss deferred, that would be basically debit to accumulated OCI, because we're going to be deferring it in accumulated OCI. So put a box around accumulated OCI and write actuarial loss deferred equals put in accumulated OCI. But if it's a deferral of actuarial gain, box accumulated OCI on the credit and write actuarial gain deferred again equals put in accumulated OCI. Now, looking at the picture that we formed here, we've said that the D of the date, that's deferral. That's a deferral because of the difference between actual and expected returns. Step number 2, that's deferral because the actuary changed his assumptions. So all these deferral we are putting in accumulated OCI, and then we are amortizing the excess deferred gain or loss using the corridor approach. So what I want you to do is put a bracket, a long one, from the D of date to step 2, and right there put these deferred gain and loss together and amortize via corridor approach. That's the A of your date. So you're putting all these deferrals together and amortizing using the corridor approach. So you're having deferral from the D of the date and from step 2. To further your understanding and try to link it backwards, now I want you to draw an arrow from where we've talked about amortization of excess deferred gain and losses to the actual amortization journal entries that we've just seen. So amortization, that was P plus A plus T. P was prior service cost amortization, but we're talking about A, which is amortization of excess deferred gains and losses via the corridor approach. So we saw the two journal entries there for amortization of loss and for amortization of gain. Now in both amortizations, you're taking it out of accumulated OCI. So when you're amortizing a loss, that increases your net pension expense, and the credit is accumulated OCI. When you're amortizing a gain, that reduces the net pension expense, because in that case you're debiting accumulated OCI. Turn on to page 46, highlight step 3 and highlight contribution to the pension plan. So this is the cash that is set aside during the year to pay for the pension liabilities. Naturally, it decreases pension liability, or if it's a net pension asset, it increases that. So the debit is to pension liability or asset, the credit is cash because cash is going out. Next, highlight step 4 and highlight PBO. So we're looking at the calculation of the projected benefit obligation. We start with highlight beginning PBO and we add highlight service cost and interest cost. Circle S, circle I, and put a bracket right step 1, because we had calculated the SIP, the S and I, from step 1, net pension expense. Now the prior service cost that you add here to calculate your ending PBO, this is not the prior service cost amortization. This is the prior service cost added during the year, only if there is a plan amendment or modification. So put an arrow and write, this is not PSC, or the prior service cost amortization, the P of the SIP. Right, rule: amortizations do not affect PBO. Amortizations affect your accumulated OCI. And then on the PBO calculations, we have highlight actuarial gain or loss from change in assumptions, and right there, step 2. Highlight benefits paid out during the year, that reduces the pension liability. Draw an arrow from there and write use pension assets to pay off pension liability. Now you've successfully calculated your highlight ending PBO. Next, we're looking at highlight step 5, and this helps us calculate highlight fair value of plan assets. Now we're going to start with highlight beginning plan assets. Then from step 3, we get the dollars that was set aside during the year, the contributions during the period. So right there, step 3, and highlight contributions during the period. So you had your beginning plan assets, plus you contributed more during this period, plus you had highlight returns on plan assets during the period. Circle the R and write step 1. Okay, so once again, you had the beginning plan assets, you made more contributions during the period, you had returns from those plan assets, and then finally highlight benefits paid out during the year to retired employees. And right, use pension assets to pay off pension liability. That reduces your pension plan assets. This gives you highlight ending plan assets. So step 4, we've calculated ending PBO. Step 5, we've calculated ending plan assets. Now we are all set for highlight step 6, where we're going to calculate and report highlight funded status of pension plan at year end. So highlight ending PBO minus ending fair value of plan assets, highlight funded status of pension plan. And make a note there, right? Report net on balance sheet. For each plan, pension asset or pension liability. So we are not going to have two numbers on the balance sheet for one plan. Either it's a pension asset if the plan assets are more than the PBO, or it's a pension liability if the ending PBO is more than the ending fair value of plan assets. So guys, if it's a pension asset, we could say it's highlight overfunded pension asset. If it's a pension liability such that the ending PBO is more than the ending fair value of plan assets, you could say that the plan is highlight underfunded pension liability. Now it says, note that funded status of overfunded and underfunded plans are not allowed to be netted. Need to report both separately. That is, for an employer with, put a box around multiple pension plans, highlight overfunded plans are aggregated. These become pension assets, and all highlight underfunded plans are aggregated. These become pension liabilities. So you're not allowed to net overfunded and underfunded plans. Now look at it, says IFRS allows netting of overfunded and underfunded plans, but only if there is a legally enforceable right to use the assets of one plan to settle the obligations, the liabilities of another plan. On page 47, we're looking at reporting the pension expense on the income statement. So we had calculated the net pension expense, SIP, rejoice and date in step number 1. That goes into the income statement. Now let's again look at SIP, rejoice and date. So you have service cost plus interest cost, and we know both these components affect PBO. So draw in bracket and write affects PBO. Now we had done S plus I minus R to start with. So S plus I, that is for PBO. The R, the actual returns on plan assets, right, affects plan assets. So the actual return on plan assets increases the plan assets and it helps us reduce pension expense. Now then we had deferrals and amortizations on our pension expense. So highlight prior service cost amortization, highlight deferred gain or loss, that is deferral, highlight amortization of excess deferred gain or loss, and highlight transition net obligation or net asset amortization. So all these amortizations and deferrals, these affect, put a bracket and write affects accumulated OCI. And also draw an arrow from the P of SIP, prior service cost amortization. So now we've looked at SIP, rejoice and date, all the components of pension expense, and we're trying to understand where does each component go to, what's the other side of the journal entry. For service cost and interest cost, they affect the PBO. For the returns and plan assets, they affect plan assets. So PBO, if you recall, that's step 4. Plan assets, that's step 5. The prior service cost amortization, the amortization of excess deferred gain or loss, or the transition amortization, that's taking out of accumulated OCI. The D of date, the deferral of gain or loss, that's putting into accumulated OCI. Note that the FASB update requires that the net pension expense components, the SIP, rejoice and date, be disaggregated for income statement presentation. So highlight service cost, that needs to be reported as, right, operating expense, as COGS or SG&A. So when you're talking about service cost for the pensions for, let's say, factory workers, that goes into COGS. Service cost for pensions of salesmen, that's selling expense. Let's say service cost for pensions of officers, that's G&A. So this service cost, which is now an operating expense, COGS or SG&A, is reported in the same line item as other compensation costs applicable to the pertinent employees during that period. However, highlight the other components of net pension expense. So that's I, P, rejoice and date. All these are going to be reported as, right, non-operating expense. So once again, under the new rules, remember to disaggregate the net pension expense. The S of SIP, rejoice, date is an operating expense, COGS or SG&A. IP, rejoice, date, all of that is non-operating expense on the income statement. So turn on to page 48 and highlight accumulated other comprehensive income. Highlight unamortized for prior service cost. Highlight unamortized for excess deferred prior gain or loss from plan assets, including highlight unamortized actuarial gains and losses. Again, highlight unamortized for transition net obligation or net asset amortization. Now, what I want you to understand is, right, unamortized means parked in accumulated OCI. It's lying in accumulated OCI. Only when you amortize it does it come out of accumulated OCI, goes to your income statement. We've already seen pension asset if it's overfunded, pension liability if it's underfunded. That's the number from your step number 6. So highlight asset if overfunded, circle or, and highlight liability if underfunded. So guys, on your income statement, you're going to have net pension expense for the year. On your statement of comprehensive income, you're going to have OCI for the year. On your balance sheet for pensions, you're either going to have a pension asset or a pension liability. Along with that, all the pension adjustments, all the unamortized portions, they lie in accumulated OCI. I'm sure you guys are all enjoying the systematic explanation for pensions that I have all across my board. Now, the concept of pensions, that's real advanced accounting. And in real life, this could get very complicated, a little tricky. But on the CPA exams, we don't go so far. It's pretty much around the basic concepts that I've just given to you. Now, as I go on through my board and do a final recap, I'm also going to give you a couple of CPA exam tips that are going to be very helpful for you to knock questions that you have on pensions on your CPA exams. So let's start with looking at the 6 steps that I divided pension accounting into, and then we'll look at pension reporting on the income statement as expense, on the balance sheet as a net pension liability or asset, and accumulated OCI. So looking at pension accounting, step number 1, pension expense, SIP, rejoice and date. So SIR, that's pension expense and pension liability or asset. PAT, that's amortization out of accumulated OCI. The D, that's deferral, whenever you have expected returns different from actual. Now you add this deferral with the deferral from step number 2, changes in actuarial estimates. Now the difference between these two is here it's affecting pension expense, here the deferral affects pension liability, but the deferral still is an accumulated OCI. Then step number 3, you're looking at how much was the contribution to the pension plan. Was the contribution equal to the expense, more than the expense, or less than the expense? In the current example or the numbers that I've been putting, I said that the pension expense is $1,760. The contribution was $1,500. So that is slightly lesser than the pension expense for the period. Now moving on and looking at step 4, 5 and 6. Step 4, we're looking at the projected benefit obligation. Step 5, we're looking at plan assets. Step 6, we are netting PBO and plan assets. So if I look at the beginning balance, so the beginning PBO was $7,600. The beginning plan assets was $2,000. So the beginning net pension liability, that was $7,600 minus $2,000, $5,600. So let me put that here. So beginning pension liability was $5,600. Now looking at the ending numbers, the ending PBO, that calculates to be $9,360. The ending plan assets, that was $3,750. Now 9,360 minus 3,750, that is 5,610. So the beginning pension liability was 5,600. The ending pension liability, that calculates to be 5,610. Now for the CPA exam purposes, there are times when you're required to understand this reconciliation. So how did the net pension liability move from $5,600 to $5,610? Now this could be due to 2 reasons. Number 1, your pension expense is not equal to the pension contribution. So the pension expense $1,760. The contribution to pension plan assets was $1,500. So there is a $260 shortfall. Now this shortfall of $260 would lead to an increase in pension liability. So guys, let's get back. So what I'm saying is the beginning pension liability is $5,600. Now there is a shortfall of $260 because our pension expense is more than the contributions that we have set aside for pensions. Now, there is another item on this reconciliation. We are looking at the change in accumulated OCI for the period. So, let's get back again. Now, S, I and R, these three, they do not affect accumulated OCI. But accumulated OCI is affected by deferrals and PAT, amortization. So accumulated OCI during the period is affected by any deferral and any amortization. So in this period, we had a deferral, yes, $50. Now this was a deferral of gain. So this actually increased accumulated OCI. Now accumulated OCI is part of equity. Equity balances are credit balances. A credit to accumulated OCI increases accumulated OCI. And we also had this amortization. Now this was also a credit to accumulated OCI. Credit to accumulated OCI increase. So ideally the accumulated OCI increased by $200 and $50, $250. Nothing else. So nothing else here, nothing here on this example. So what we can say is accumulated OCI during the period increased by $250. Now if accumulated OCI increases, the liability would decrease for the balance sheet to match. So with this understanding, let's put a number there and we'll come back to reporting. So the beginning pension liability was $5,600 plus $260, the shortfall contribution, minus $250, that's the increase in accumulated OCI. So if accumulated OCI increases, the liability would decrease. So 5,600 plus 260 minus 250 gives us 5,610. So that's the reconciliation between the beginning and the ending. So this could be a useful tip for you on your CPA exam question. So let's go back again to reporting and put the results that we have from accounting on our financial statements. So pension expense 1760 here. Net pension liability. So we started with net pension liability of 5,600 and we said there was a shortfall contribution of $260 increased liability minus 250 because accumulated OCI increased by 250, so liability needs to decrease by 250. That gave us ending of 5,610 net pension liability. So that's the number that you have on your pension liability. And all the unamortized prior service cost, unamortized excess, deferred gains and losses, all those amounts would be lying in accumulated OCI. Now, I've just used random numbers for the examples that I've built out here. What we'll do is, as we come back, I'm going to look at a full-blown example that you have on your book, which is going to make sure that all the pieces that you just learned ties in together. On the second half of page 48, right, exam tip. And this is a very useful tip, especially when you're solving multiple choice questions on pensions. Right, change in funded status of plan during the year. This is equal to the difference between pension expense for the year in step 1 and contributions during the year in step 3. And to this you need to add, right, change in balance of accumulated OCI during the year. So if your question is trying to ask you how the funded status of the plan has changed from the beginning of the year to the end of the year, you're going to use these calculations. You're going to look at what's the difference between the pension expense for the year, the amount that should have been contributed versus the amount actually contributed. Along with that, you're also looking at how the balance in accumulated OCI has changed during the year. In other words, you can write, therefore, increase in pension liability means pension expense minus contributions. Generally, you had a higher pension expense but less contributions. And it would also be due to, right, plus decrease in accumulated OCI. and you could write decrease in pension liability. So your pension liability end of the year has reduced from what it was in the beginning of the year. That could be because contributions were more than the pension expense, right? Contributions minus pension expense. And it could also be due to increase in accumulated OCI, right? Plus increase in accumulated OCI. Now, I want you to make a note of all this. This might sound a little vague, a little complicated, and we'll look at this again when we're doing our example on page 50 and 51. Now let's look at a comprehensive example on pension accounting that we have on our textbook. Now, before I go ahead with the example, let me clean up the board a bit. Let me clean up all the numbers. So, get this off, get this numbers, 1760 off, numbers all out. Got no numbers here, that's it, 1500 off. Cleaning off the numbers so that I can use the same template for that example. Yeah, we're good to go. Okay, now picking up on this example, it says, at Jan 1st, year 1, Pen Company had an average remaining employee service life of 20 years. So the average remaining employee service life, 20 years. Expected return on plan assets. So we know plan assets, they have an expected return. The actual could be different from expected. So that's 10%. And they've got a discount rate of 9%. So discount rate we use to calculate this interest cost. So that's beginning PBO into discount rate. Now, the additional information, Jan 1st, year 1, that's the beginning of the year. They had fair value of plan assets, $300,000. PBO, $700,000. So let's put in these numbers in place. So the beginning PBO was 300. Sorry, the beginning PBO was 700. And the beginning fair value of plan assets, that was $300,000. And they had unamortized prior service cost $250,000, unamortized net loss $120,000. So guys, unamortized portion of cost losses, where does unamortized stay? It stays in accumulated OCI. So let's draw a T account for accumulated OCI out here. Now, since this is an unamortized prior service cost, that will be a debit because that's like a loss, a liability. An unamortized net loss, that again would be debit. So we have a debit of 250,000 and 120,000, total of 370,000 beginning unamortized in accumulated OCI. Now, they've given us additional information. Contribution to the pension plan was $220,000. Benefits paid out $150,000, actual return on plan assets $35,000, service cost $200,000, net actuarial loss due to a change in actuarial assumptions $15,000. Guys, this is a lot of information. So let's put this information wherever we know we can fit this. Contribution to pension plan, I know that's step 3. So that would be $220,000. Benefits paid out $150,000. Benefits paid out, we had it here, that decreased the liability PBO, decreased the plan assets. So this was negative $150,000 and a negative $150,000 out here. Now you had actual return on plan assets $35,000. Actual return that comes in here. Now let's also put the actual returns R of pension expense. That's the SIP rejoice date. The R, this is returns actual. So this reduces pension expense by $35,000. Now guys, what is the expected return on plan assets? That 10%. So the beginning fair value of plan assets is $300,000. We expect a return of $30,000. We made $35,000. So we would now defer the gain. So we would add back the deferred gain $5,000. So if you look at it, minus $35,000 plus $5,000, that's negative $30,000. That's the expected return. So this plus this should give us expected return. Service cost $200,000. And you had net actuarial loss due to a change in actuarial assumptions. This fits in step number 2. Change in actuarial assumptions, and this is a loss. So this journal entry, you have $15,000. Looks good. Now let's fill in all the blanks that we have. So let's first start with step number 1. So we already have the service cost number, $200,000. Now interest cost, that should be beginning PBO into discount rate. Beginning PBO, that's $700,000. Discount rate, they've given 9%. So $700,000 into 9%, that's $63,000. Then we have prior service cost amortization. Now the unamortized prior service cost is $250,000 in accumulated OCI. Now we know that the average remaining employee life, that's 20 years. So this $250,000 needs to be amortized over 20 years. So 250 by 20 gives us $12,500. So the prior service cost amortization here is $12,500. Then you have the return on plan assets, it's already done. Deferral of gains and losses. So this plus this, minus 35 plus 5 gives us minus 30. That's the expected return on plan assets, $300,000 into 10%. Then let's look at the A of date, amortization of excess deferred gain or losses. Now the beginning deferred loss is $120,000. Now we need to check if this is more than the corridor limit. Now corridor limit is the higher of beginning PBO or the beginning fair value of plan assets into 10%. So let's get that. What's higher? 700 or 300? 700 is higher. 10% of this, $70,000. Is $120,000 more than $70,000? Yes. How much? 120 minus 70 gives us $50,000. And that $50,000 would be amortized over 20 years, the average remaining service life. So by 20 years gives us 2,500. Now this is amortization of loss. So when you amortize loss, pension expense would increase. So we are amortizing the loss 2,500 here. This was deferral of gain. So deferral of gain fits in here. Now with this, no transition. So with this, let's calculate the total pension expense, the net pension expense. 200 plus 63, 263 plus 12.5 minus 35 plus 5 plus 2.5. The total calculates to $248,000. So that's the pension expense number on the income statement. Let's look at step 2. That's already done. We've fit in the numbers here. There was an actuarial loss of $15,000 deferred and this was due to change in actuarial estimates, actuarial assumptions. Now, $220,000. Let's fill in the blanks for our PBO and plan asset calculations. Now, beginning PBO, that's $700,000. Now, from the pension expense calculation, we know service cost is $200,000. Interest cost, that's beginning PBO $700,000 into 9% discount rate, $63,000. No prior service cost in this period. Now, we had unamortized prior service cost in accumulated OCI. So, it's already hit our liability in the past. Now, there's no change, no amendment in plan creating prior service cost in this period. So, this is zero. Then we are looking at actuarial gain or loss, and we had an actuarial loss. Loss means plus would increase the liability. Now, this is $15,000. So now 700 plus 200, 963 plus 15 gives us 978 minus 150 gives us 828 ending PBO. Looking at the numbers on the plan assets now, $300,000 beginning fair value of plan assets plus contributions. This year contributions, we know we get this number from step 3. So this was $220,000. So guys, change in actuarial assumptions, the number came in from step 2. Contributions to pension plan, the number came in from step 3. Returns, we've already plugged the number, $35,000. Benefits paid out, $150,000. So this calculates to $405,000. So now, if you're looking at the beginning pension liability, the beginning pension liability was 700,000 PBO minus plan assets 300. This was 700 minus 300, which was $400,000. Now the ending, that's 828 minus 405. So $828,000 minus $405,000. Now this calculates to $423,000. So guys, as you can understand, I've used the template that I have for my 6 steps, and it's become very easy. I just had to plug in the numbers. So if you remember this template, understand it sequentially the way we've done it, you can actually recreate it by any chance if you have a simulation on pensions on your exams. Now, moving on to the next page on the example. Okay, so we are looking, let's also look at the journal entries for our step 1. We haven't done all of them. So if I'm looking at S plus I, $263,000, so that's a pension expense debit to pension liability. And we've taken this number for PBO. Returns, this is $35,000. And we've taken this number for calculating the ending fair value of plan assets, and naturally that nets up with the pension liability number. So ideally, if we had done S plus I minus R, the way we have on the book, it would have been $228,000, 263 minus 35. Now, we have deferred excess gain on plan assets, so that's $5,000. We have amortized prior service cost, $12,500, so that's the journal entry for this. We have amortized excess deferred loss, $2,500. This was the corridor approach. So step 2 we've already done, step 3 we're done, 4, 5 done, step 6 we're good to go. Now looking at step 6, we have the beginning pension liability of $400,000. Now that became $423 at the end of the year. Now let's reconcile, and I told you the change could be due to 2 reasons. Number 1, the contributions were not equal to the pension expense, and number 2, related OCI. So let's get there on the dashboard and reconcile how $400,000, how did it become $423,000 by the end of the year. So the beginning pension liability was $400,000. Ending, We know it's $423,000, but let's be very sure about it. Now, the pension expense for the period was $248,000. How much was the contribution? So, expense was 248, contribution that was only 220. So, there was a 28,000 shortfall out here. So, shortfall would have increased the liability. So, let's add it here. So, plus $28,000. So, this is basically expense was 248, contribution was 220. Now, let me fill in this T account that we have for accumulated OCI. Now, we had 250 and 120. That was the beginning unamortized. So, this was the beginning unamortized prior service cost. 120,000 was the beginning unamortized loss. Now, we had a deferral in step 1. So, we had this one $5,000. This was a deferral in step 1 where we deferred gains. So, expected returns was 30, actual returns was 35, 5,000 gain deferred. Now, deferral of gain, the credit was accumulated OCI. So, naturally this one increases accumulated OCI. Guys, remember accumulated OCI, that's part of your equity, that's a credit number. So, as you credit it further, it increases. So, 5,000, this is deferral from step 1. Now, next we had a deferrals from step 2. Let's look at that. So, we had a change in actuarial estimates, change in actuarial assumptions. Now, we deferred the actuarial loss of $15,000. Now, this increased the liability and reduced accumulated OCI. A debit to accumulated OCI is a reduction. So, this loss got deferred. So, let's put this deferral on the debit side of accumulated OCI. So, we'll have $15,000. This would be deferral, and this is a deferral from step number 2. Now, what remains is patting the accumulated OCI. Remember, pension expense is SIP rejoice date, and a subset of that is PAT. So, you pat the accumulated OCI every period so that you can amortize. Now, if you look at this, we have amortized the prior service cost, $12,500. So, that was basically this $250,000, and we amortized it by over 20 years, and the number was $12,500. So, this got amortized, and we had $12,500 because this was amortized over the average remaining service life. Now, $120,000 of beginning deferred loss was amortized using the corridor approach. So, we said $120,000, that's more than $70,000. That was 10% of the beginning PBO, which was a higher number. And we amortized that over 20 years. So, the amortization for this period was $2,500. So, again, $120,000, $2,500 is amortized. Now, let us look at what's remaining in accumulated OCI at the end of the year. So, you had 370 plus 15, 385 on the debit, and you had 20 on the credit. So, this became 365 on the debit now. Now, a debit balance to accumulated OCI means a negative accumulated OCI. So, at the beginning of the year, it was a negative $370,000. At the end of the year, it was a negative $365,000. Now, this means that accumulated OCI during the year has increased by $5,000. Now, if this is increased by $5,000, naturally the liability needs to decrease. So, minus $5,000, say increase in, or rather let me put it like this, accumulated OCI has gone up. So, liability needs to come down. So, $400,000 plus 28 minus 5. That gives us the ending number of $423,000. This means we have done all our calculations correctly. We are good to go. So let's look at the final numbers that we'll have on our financial statements. $248,000, this would be the expense on the income statement. $423,000, this would be the net amount by which the pension plan is underfunded, net pension liability on the balance sheet. $365,000, this would be the ending balance in accumulated OCI, the ending unamortized portions of prior service cost and of deferred losses. So guys, this was a pretty comprehensive example. Generally, I would not expect simulations on pensions to be coming on your exams, but still, we should be good with the concepts. And even when you're doing multiple choice questions, they would be small pieces of the entire stuff that I have on the board here. So steps 1 through step 6, that gives you all about pension accounting. On my dashboard here, you got pension reporting. So now I'm sure you guys are geniuses in pension accounting and reporting. Now let's get to page 51 and look at the example that we have on pensions. So I'm looking at the solutions where I have broken down the pension accounting into 6 steps. Highlight step number 1 and highlight net pension expense. So looking at the first journal entry there, where we have net pension expense debit and the pension liability credit. So that is 200,000 of S, that's service cost, plus 63,000 of I, interest cost, less $35,000 actual returns. So right there, S plus I minus R. Now the next journal entry, that's to defer the excess gain of $5,000 on plan assets. So the actual return was $35,000, but the expected was only 30. So defer the excess gain on plan assets. So write D there. The debit is to net pension expense. The credit, that's to OCI for the period which goes into accumulated OCI. So right there, defer excess gain on plan assets. Now then let's look at the amortization journal entries. So the next journal entry is to record amortization of prior service cost of $12,500. So when you amortize it, you're increasing your pension expense and the credit is to OCI. So write P there and write amortize prior service cost. You're amortizing a loss. You're taking it out of accumulated OCI. The next journal entry, that's to record amortization of deferred net loss of $2,500 via the corridor approach. So write A there and write amortize excess deferred loss. So when you're amortizing a loss, that increases the pension expense and the credit is to OCI on your comprehensive income statement, which then flows into accumulated OCI on your balance sheet. So that's all about step number 1. Next, highlight step number 2 and highlight change in actuarial assumptions. Now there was an actuarial loss which we're going to defer. So write defer actuarial loss. Whenever you're deferring it, you're putting it into accumulated OCI. So the debit is to OCI, the credit is to the pension liability. Next, looking at highlight step number 3, highlight contribution to the pension plan, the actual cash that was set aside during the year, and that was $220,000. Then you have step 4, 5 and 6, but the numbers from these 3 steps, they flow in from the previous page. So now let's go back to page 50. On the second half of page 50, we got calculations for ending PBO, ending fair value and the funded status of the plan. So where we have PBO calculations, write step 4. So the beginning PBO was $700,000. plus service cost during the year 200 plus interest cost 63 plus actuarial losses during the year 15,000 less benefits paid out 150, ending PBO 828. Now looking at fair value of plan assets, right there, step number 5. Beginning fair value of plan assets was 300 plus contribution during the year 220. Actual returns on plan assets during the year 35 less benefits paid out 150. That gives you ending fair value of plan assets 405. Now we're going to calculate the funded status of the plan, right? Step number 6. So the fair value of plan assets, that was 405, but the ending PBO 828. So it's a pension liability $423,000. Now with these calculations in place, let's go back again to page 51. Back on page 51, highlight step 4 gives you highlight ending PBO. Highlight step 5 and highlight ending fair value of plan assets. Highlight step 6, that gives you highlight funded status of plan. So in this case, the plan is underfunded. There's a pension liability of $423,000. Now let's do an analysis on the T accounts that we have for the pension liability and for accumulated OCI. First, let's look at the pension liability. Right there, net, because this is a net pension liability. So the beginning number, highlight $400,000, that is right, beginning PBO minus fair value of plan assets. Beginning PBO was $700,000. Beginning fair value of plan assets, that was $300,000. That is a net pension liability at the beginning of the year of $400,000. Highlight $423,000 and write ending PBO minus fair value of plan assets. So the ending PBO was $828,000. Ending fair value of plan assets $405,000. So the ending net pension liability was $423,000. Now let's look at the T account for accumulated OCI. So you have a beginning debit 250 plus 120. Put a bracket and write beginning unamortized. So you had a beginning unamortized prior service cost $250,000. Beginning unamortized net loss $120,000, and we know all the unamortized portions, they lie in accumulated OCI. Now during the year we had deferrals. So for $5,000 on the credit, write deferral step 1, because this is the deferral of the excess gain on plan assets. So we had a gain of $35,000, but we expected only $30,000. So we deferred the $5,000 excess gain. That is step number 1. Now for $15,000 on the debit side, right, deferral step number 2. Now this is the deferral of the actuarial loss, the change in actuarial assumptions that we saw in step 2. Then you have two credits, 12,500 and 2,500. 12,500, that's the amortization of prior service cost. 2,500, that's the amortization of excess deferred loss using the corridor approach. So put a box around both these numbers and write amortization. So guys, you had beginning unamortized, you had deferrals during the period where you put it in accumulated OCI, you had amortizations during the period where you take it out of accumulated OCI. Finally, you calculate $365,000, that is right, ending unamortized. Now let's try to reconcile the exam tip that I gave to you on page 48 to the example that we have right here. So on the little space that you have on the bottom of page 51, right, increase in pension liability. Because we've seen that the net pension liability that's increased from $400,000 to $423,000. Now that could be due to contributions less than the pension expense as well as decrease in accumulated OCI. So right there, pension expense minus contributions, because if contributions are less than the expense, naturally the liability is going to go up, as well as it could be due to decrease in accumulated OCI. So if accumulated OCI goes down, naturally the liability number would be going up, because both accumulated OCI and pension liability are on the same side on the balance sheet. Both are credit balances. So naturally, if accumulated OCI goes down, pension liability is seen going up. Now let's put the numbers. For pension expense, the number is 248. That's from step number 1. Pension contributions, the number is 220. That's from step number 3. Now looking at the accumulated OCI balances, the beginning balance of accumulated OCI was debit 370. The ending balance on accumulated OCI was debit 365. Now accumulated OCI, that's part of equity. It's supposed to be having a credit balance. But then since you had unamortized losses, it had debit balances. Now a debit of 370 at the beginning of the year became 365 at the end of the year. So actually you could say accumulated OCI increased. So when I'm looking at the decrease in accumulated OCI, no, it's increased. So write -5. So that gives us 248 minus 220 is 28. 28 minus 5, write 23. That is how we've seen that the net pension liability has grown from 400 at the beginning of the year to 423 at the end of the year. An increase in pension liability of $23,000. And this calculation I've shown you because this is the piece that they really want to test on your CPA exam multiple choice questions. Most of the employers in the private sector currently use defined contribution plans for their employees. But on the CPA exams, the focus is on defined benefit plans because that's the kind of plans that has filled up our entire board today. Now, as you can understand, there's a lot of calculations going on these plans before you can report numbers on the financial statements. Hence, the requirement for a lot of disclosures. So if you're using a defined benefit plan, make sure you disclose on your financials how you have calculated the net pension expense, SIP, rejoice and date. You would need to disclose the impact on other comprehensive income for the period. You would need to have a reconciliation for your projected benefit obligations, this schedule here. You would need to have a reconciliation for your plan assets, this one. You would need to have how you calculated your funded status of the plan, underfunded or overfunded. Now, apart from this, you would also need to disclose ABO, that's the accumulated benefit obligation. Now, on your CPA exam questions, you often have ABO numbers. Remember, you need to simply ignore them as we use PBO for pension calculations. PBO is projected benefit obligations based on future salaries, because that's the salary upon which all the pension benefits are going to be based. So ABO, accumulated benefit obligations, which is based on current salaries, is for disclosure only, not for calculations. Now, other disclosures for pensions that you need to have is a detailed description of the pension plan, the rates and assumptions. So what's the discount rate? What's the expected rate of return on plan assets? What's the projected compensation increase which you use to calculate the future salary levels for PBO? What's the amortization method for prior service cost? Are you using straight line method or expected years of service method? Now, along with all these disclosures, you would also need to disclose what are the benefits that you expect to pay out to your employees over the next 5 years. You would also need to disclose what is your expected contribution during the next fiscal year. So a lot of disclosures for pensions. So defined benefit plans means a lot of calculations, a lot of accounting, and a lot of disclosures. On page 49, we're looking at pension plan disclosures. As you can totally understand, pensions, they can be really complicated. And naturally, because they're so complicated, there's a lot of required disclosures. So you are required to disclose, highlight components of net pension expense, SEP, rejoice, and date. Highlight reconciliation of PBO, projected benefit obligations. Required to disclose, highlight reconciliation of fair value of plan assets. Now, we've been always talking about PBO. We never talked about ABO, that's accumulated benefit obligations, because that's based on current salary levels. That's not used for calculations. So highlight ABO, and also highlight ABO is only disclosed, not used for calculations. And this could be really important because often on CPA exam questions, you have the ABO number right there. You have to learn to ignore it. When we started pensions, I told you that the employer, he tells his employees, give me all that you have, work for me 100 hours a week for the rest of your life, and I'm going to take care of you even after you retire. Now that the employer has already shown the carrot called pensions, he now takes out another carrot, and this carrot is called other post-employment benefits. Now this carrot is not as big as the pensions carrot, but this one could be important as this includes healthcare benefits. Now, couple of difference that other post-employment benefits, healthcare benefits have from pensions that you need to remember is, number one, for these other post-retirement employment benefits, use ABO, not PBO. Now, ABO here is called APBO, that's accumulated post-retirement benefit obligations. And the second thing is, generally these are not funded, so there are no plan assets. So if you look at the expense, that would include only your SIP, service cost, interest cost, and any prior service cost amortization. Since there are no plan assets, there would be no returns on plan assets, no need of deferral of excess gains and losses, and there's no need of amortization of those excess deferred gains or losses. So generally the focus is on the SIP for the expense part. Now, one crucial point that you need to remember for this other post-employment benefits is that costs should be matched to the period of service required to qualify. For example, if a company has an eligibility criteria of 10 years of service to qualify for post-retirement health coverage, an employee who's hired, let's say at 30, must have his healthcare benefit obligation accrued by the time he is 40, not 65, because as the employee does not need to work beyond 40 to qualify for those healthcare benefits. He would get those benefits even if he calls it a quit at 40. On page 52, we are looking at other post-employment benefits, OPEB. Now the most important one here is highlight healthcare benefits. and make a note which says generally not funded and have greater variability. Now, looking at the key differences of these OPEBs from the pension plans, highlight use APBO, that's accumulated post-retirement benefit obligation instead of PBO. Next one, highlight costs for OPEB are generally not funded during the service period. So there are no plan assets to account for, and costs generally include only SINP, the service cost, the interest cost, and the prior service cost amortization. Next sub-bullet says, since employees qualify for OPEB after a certain number of years, highlight costs should be matched to the period of service required to qualify. So you're not looking at the entire service time up to retirement. Thus, highlight obligation must be fully accrued when the employee is fully eligible for benefits. And on this page, we're talking about the income statement reporting, the balance sheet reporting, and the last one, disclosure. So on disclosure, you have APBO, you have status of overfunded and underfunded post-retirement plans, brief plan description, summary of significant accounting policies. But the most interesting one that I find here is assumed trend rates for healthcare costs. And here, you're also required to disclose, highlight effects, and highlight in case of 1% increase or decrease of the trend rates. So what happens to the numbers for these OPEB healthcare benefits if the healthcare costs increase or decrease?